This is Declarations.
The vast majority of the wealthy families I've worked with, they want to do good things with their money. They want to leave a legacy, but they need help. And so the family office is important.
Hi, this is Todd Rich, and welcome to the Declarations podcast. Declarations is a podcast where top investors and business leaders share their insights and provide an independent perspective. Our goal is to uncover the stories behind their success and understand the principles that guide their decisions in life, family, and business. Through these conversations, we hope to become better investors. Today, I'm thrilled to welcome Bill Woodson. Few people have thought more deeply about what it really means to build, preserve, and transition family wealth than Bill Woodson. Bill is a nationally recognized leader in wealth management and family office advisory. He serves as the co-head and managing director at Cynosure Wealth Advisors, a division of the Cynosure Group founded by the Eccles family of Utah. At Cynosure, Bill is helping expand the firm's wealth advisory platform, integrating investment expertise with deep, personalized advice for families who are building, preserving, and transitioning wealth across generations. Before joining Cynosure, Bill held senior leadership roles at firms including Silicon Valley Bank, Citigroup, and Credit Suisse, where he built and led teams advising some of the most successful families and entrepreneurs in the country. Bill is the co-author of The Family Office, a comprehensive guide for advisors, practitioners, and students, and he was named one of Family Capital's 100 top influencers. Bill is a lecturer in the Masters in Wealth Management program at Columbia University and an advisory board member for the University of Chicago Booth School's Family Office Initiative. Bill has spent his entire career at the intersection of entrepreneurship, finance, and family governance, helping founders, business owners, and multi-generational families navigate the complexities and responsibilities that come with significant wealth. Bill, welcome to the show.
Thank you, Todd. It's a pleasure to be here.
Well, Bill, as you know, I like to start all of these podcasts the same way. What is your declaration?
Well, I've given that some thought, and I think it's a declaration that I hope many others share, which is to lead a purposeful life, to try to leverage my experience, my talents, and my areas of interest to contribute. And in my particular area of expertise and experience, it tends to be working with very wealthy families, helping them sort of achieve their purposes in a more thoughtful way in light of the challenges that come with substantial wealth. And I hope that I do that not just during my life, but I can contribute beyond, which is part of the reason for publishing the book that you mentioned, is so that I leave some of that for future generations to reflect upon and rely upon in their efforts to overcome those challenges.
Got it. So to lead a purposeful life, I think that's fantastic. We'll come back to that, but maybe from the beginning, take us back. Where did you grow up and what was it like?
Sure. Well, my dad was a management consultant, one of the big accounting firms, and traveled extensively. And so we moved around quite a bit. And so I had both the challenge and the training, so to speak, of acclimating to new environments every couple of years, which turned out to be very, very valuable. But for the most part, I would say I grew up in Southern California, where we moved when I was just starting high school, and ended up, as attending UC Irvine undergrad, and before heading to New York to go to business school at NYU Stern.
So just before we get to the formal education, you mentioned that it proved valuable to move around so much as a kid. In what ways? What were the lessons that you took from that experience?
Well, look, you realize that in order for you to connect, you have to lead in that effort. You have to lean in. You have to reach out. You have to invest some time. You get out of it what you put into it. And so, not knowing folks can be a challenge, particularly as an adolescent. And so I had to develop not just the approaches, but I had to develop the confidence to be able to start new conversations with people that I didn't know every couple of years.
Yeah. It amazes me every time I have one of these conversations, I hear a consistent theme here that actually learning to overcome the challenges in life seems to be the most important thing when it comes to building your own capabilities later. So that's a consistent theme. Now, you went to UC Irvine, as you mentioned, and I think studied economics, which makes sense given its analytical environment there. Now, tell us, what about UC Irvine influenced you, and how did that ultimately, convince you to have the confidence, as you said, to approach founders and business owners and advising them?
Yeah, well, I had a bit of a different college experience in that I paid for most of my own college. And so I was working for most of those years. And so I think what I learned that contributed later on in life was just the discipline that comes with not having a whole lot of time and having to get a lot of stuff accomplished, to having to manage your budget so that you can afford the lifestyle, but also pay for the tuition and the books and the related. And so that discipline really lent itself to my professional career. But I started out working for an investment firm back in 1987, going way back. I started out understanding how that particular firm advised wealthy clients, particularly around investment management, and took a keen interest in it, which, while I departed to go to public accounting, which we'll get to, I ultimately found my way back to Wall Street and working with investment management firms.
That's interesting. As you know, I think my dad was an accountant as well. And so I have a ton of respect for people who do accounting. I usually find that it's rare for people who start in the investment world to then go to accounting. I find it much more common for people to start in accounting and then go investment. You sort of done full circle. So maybe just a little bit on that. What was the appeal to you in going to New York and getting a master's in accounting?
Well, as is often the case, it's more serendipity than it is pre-planning. My father, through his connections in public accounting, introduced me to somebody in New York who ran a very unique program for the Big Eight at the time, where within the audit division, they wanted to recruit students from liberal arts schools, believe it or not, many of them from the Ivy League, because they wanted to broaden the skill set and the abilities of their auditors. And I learned about it through him. And even though economics is sort of not formally liberal arts, it was liberal arts enough for me to qualify. It was not an accounting or a business degree. Most of the other students were history majors and art majors, so really liberal arts. And so they send you to NYU to learn accounting. And it's very much a sink or swim program, just given our backgrounds. You either get it or you don't get it. And I did very well in the class. They bring you in as a staff auditor, and you got to go to school full time in the summer semester, which is great. But then you had to work for the fall and the spring and go to school at night. And so it built sort of a discipline around you.
But you must have liked it, because you actually spent another 10 years doing this.
I liked public accounting. I ended up migrating to tax shortly after the program ended because I had a keen interest in it. But I very much enjoyed public accounting, the training, the discipline, the caliber of the clients that you work with, the diversity of the issues, particularly when you dealt with the personal issues. And I think that's really what led me to my career post Anderson in service to wealthy clients. Was I had an appreciation for the challenges and the issues they face, the diversity of it, my ability to contribute to it.
So let's talk about that transition. I guess you must have worked with a lot of founders or business leaders, both on their businesses and, as you suggested, with them personally, both on tax issues and other issues. What did you learn from that experience that ultimately led you to believe it's that realm that you'd like to dedicate your life to?
The impact you can have on them. It's not just saving them taxes. It's helping them with the estate planning, helping get their affairs in order as a component of the planning that you were doing, helping them with their philanthropic ambitions, as many of these folks have, as you know, significant wealth as they want to give back. And they increasingly, over my generations of working with them, they want to do so more during their life than just at death. It's the risk management issues, because what comes with wealth tends to be assets, publicity, that you can become a target. And then finally, it's the interpersonal, managing the dynamics as we get into conversations around family offices and having deep personal relationships. I think many people who have CPAs working with them, they've done so for decades. They know them intimately well. They know all of their family members. They are a extraordinarily valuable member of their professional cohort, and they are distinguished often from the other advisors that they've got because of many of those attributes.
I agree with that description. Now, is that ultimately what led you into working in a family office? Did you go directly from accounting to one of your clients?
I did. Yeah, one of my clients, a very prominent multi-generational cross-jurisdictional family, the father had a stroke and became incapacitated. And the daughter, who was 34 years old at the time, said, look, we really would like your help. Would you please join our family office and help not just manage the businesses with me, but also help manage the broader infrastructure and the investments? And so for me, it was, as is often the case, an opportunity for me to migrate into broader areas of responsibilities, working for a single family, helping them achieve some of their goals and objectives in a more meaningful way than I could in public accounting. And it was the right time in my career. I had learned a lot at Arthur Andersen, which I left Cooper's to join the tax department. And I felt like I was interested in exploring a new chapter, new challenges and new opportunities.
And then you stayed at that family office for a while, eventually moved to private banking. As you would describe, is that a further expansion, moving from advising one client, as an embedded family office executive to advising more than one?
Yeah, actually, I got a phone call. It wasn't private banking. This was in Silicon Valley at the time. And I got a call from a former colleague of mine, a professional colleague who was running the family office for Jim Clark of Netscape fame and John Skeeters of Cisco and John Doerr of Kleiner. And he said that Jim Clark was starting this new company, which today would be called the multifamily office, called My CFO.
My CFO, that's right. I remember.
And it was just an opportunity I couldn't pass up. I was literally their first hire after Clark decided to really launch this thing, and what they needed were advisors to help the technology entrepreneurs that they had as clients and they expected to get as clients. And so I came in early when we were just building the firm. We had as part of our ambitions a technology component to use this new thing at the time called the internet to try to collect information from all these different sources that would help wealthy folks see what they own, potentially prepare tax returns. And that was very interesting to me. And I understood and saw the value in it. And so it was a combination of that technology vision with a more traditional multifamily office vision. And I was one of the principal architects of the latter and built a fairly significant practice doing that.
I can't help but just in the current environment note, my CFO, if I'm correct, did not ultimately stand the test of time. And yet now we have the AI influence, which may actually make some of those ideas more accessible. Do you think there's another round, another life to come for an idea like that?
Yeah, look, I think you're absolutely right. It had two components to it. One was the multifamily office business, and the other one was the technology vision. Both have flourished in different forms. So many of the largest, most respected RIAs today came out of my CFO, as Speary, Pathstone, and others, because the multifamily office business was very successful and continued to be successful, and they have grown tremendously. On the technology side, what today is called consolidated performance reporting didn't really survive my CFO. It got picked up on by Caterpillar, by others, and really has become now more ubiquitous in the industry. And so on the one hand, I'm sad that my CFO didn't see those evolutionary products evolve over time as part of the firm, but I'm pleased to see that what we did then still exists today, admittedly in different forms.
So after my CFO, is that when you got into private banking?
After the dot-com bubble burst, what we realized was the technology vision really wasn't going to be able to play out the way that we had hoped. And so what we really were was a integrated wealth planning firm for very wealthy clients with a heavy orientation to Silicon Valley technology entrepreneurs. And my CFO sold to Harris Bank. So I and some colleagues from my CFO left and went to Merrill in San Francisco, the private banking and investment group, shortly after they had formed it to create an ultra high net worth branded practice within Merrill Lynch. and became a broker, for lack of a better word, having to work with clients principally on their investments, but obviously using my planning. And it was an enormously valuable learning experience because planning was my foot in the door with a lot of these families. Who doesn't want to talk to somebody who's not going to charge them an hourly rate to help them plan their estate or reduce their taxes? And that would establish a relationship that gave me great insight into what their other needs were, that then allowed me to drive investment solutions while at Merrill Lynch. And ultimately, at the end of my tenure at Merrill Lynch, I became an investment firm. We knew a lot about taxes. I would constantly hear from my clients. So that was for me, that was my entree into quote unquote broadly private banking, so to speak, or the years post my CFO and pre-Credit Suisse, which came after the Merrill Lynch tenure.
So given this experience, maybe let's spend a minute talking about what I'll call the family office ecosystem, right? So you've advised families as, in effect, an embedded CFO, right? Part of the embedded single family office. You've advised as part of a tech platform and wealth management firm. You've done a variety of different wealth management investing through private banks, broadly speaking. Maybe if you could just explain, for the listeners, what are some of the key issues that are common to all of these different clients? What are some of the things that people of extraordinarily wealth have to face?
It's a great question, and I've thought about it at length. First, I'll define the segment because the magnitude of the wealth informs the answer, which is when you get to a point beyond, at the very minimum, 30 million, your life becomes complicated. And principals say this to me all the time. I have the best lawyer, the best accountant, the best financial advisor, the best insurance agent, but I still feel like my life is too complicated. I'm still having to do too much. And so what is missing in that is what family offices deliver, which is they take the principal out of the position of having to be the hub through which all of these disparate advisors spoke into the position of the family office coordinating all of the disparate advice and services on behalf of the principal. And so that is the greatest challenge that a lot of these families at that wealth level face. They're not wealthy enough where they choose not to create their own family office. They've got the right advisors, but none of them are stepping up into that coordination, governance, integration role. And so they struggle, and they don't have the thing that no amount of money is going to get you any more of, which is more time. And so a solution adopted by the very best in our industry is to step into that role as a quasi-family office or a hybrid family office, where you're perhaps playing one of the roles. You're managing the money, you're doing the taxes, you're giving the legal advice, but you've added to that your coordination role, your governance role amongst the various advisors. And then in a perfect world, those advisors have permission from the client to communicate everything with each other, to work together on behalf of the clients. And then all of a sudden, things get done behind the scenes and the clients get simplified.
On the one hand, it sounds like an extraordinary set of conveniences that would allow that. On the other hand, it must also require extraordinary levels of trust. And so how, if I'm an extremely wealthy person and I'm contemplating, maybe I just had a liquidity event or something, and I'm contemplating whether or not I want to maintain some level of control over all of these various parts of my wealth life, or I want to utilize a multifamily office or some sort of wealth planning quarterback, or whether I want to have my own single family office. In any of those cases, I guess I have to really trust the people that I engaged, on my behalf. What are some of the lessons that you have seen or that you have offered to people when going through that transition?
Well, some of that is understanding where they are. So many of them are self-made. They're very controlling. They're not used to outsourcing things. And for them, you have to go slow to go fast. You have to sort of, piecemeal as they evolve into trusting you and accepting that there's a benefit to relying on these other folks, and that in order for the advisors to serve them, they need to know a lot about. And that takes time. For other clients, they're happy to hand that off because, and this is something I've heard time and time again, They say that the reason that they're wealthy is not because they wanted to be wealthy. It was because they loved what they were doing in building a company and developing a technology, and it just so happened to create wealth. And so now the wealth has become their job, and it's not what they're interested in. They want to continue to build companies, develop technologies. And so they're delighted to be able to hand it off to somebody that they trust based on the background and approach.
Yeah, fascinating. You're really an advocate for family offices. I've heard you describe that family offices can have a positive role to contribute to society, not just to the wealthy family, but maybe more broadly by professionalizing the role that major wealth can play throughout, investing, philanthropy, et cetera. Can you explain a little bit about what you think some of the positive externalities are, so to speak, of the family office ecosystem?
Yeah. Well, look, for the vast, vast majority of the wealthy families I've worked with, and I've worked with many, as you know, they want to do good things with their money. They are significant philanthropists. They are keen on impact investing. They want to raise well-adjusted kids who are going to be the stewards for some or all of the wealth that they've got. They want to leave a legacy, but they need help because they don't know how to do all of that. They don't have the experience. And so family offices are the wealth managerial function for these wealthy families. And so the family office is important. And these are important responsibilities that oversee an enormous amount of wealth. This subset of our population is few in number, but extraordinarily wealthy as a percentage. And so the more professional families offices are, the more talented the people are that work in family offices, the more assisted they can be by research and education on best practices, the more they connect with their peers, because it is a different world living in a family office, the more effective they will be in achieving that goal, which is to help those wealthy families do good with their wealth, which is the lion's share of it, of the families that I've known. And that in itself means that you are contributing to the philanthropy effort, the direct investing effort, the stewardship effort. And that investment pays dividends for a long, long time. And that's also where, going back to, what my declaration is, your purpose expands beyond what it is that you're doing for your own personal professional career. It's the contribution you're making to this broader family and the future generations of that family, knowing how important your intervention and your assistance or guidance can be.
Hi, this is Todd Rich. Thank you for listening to the Declarations podcast, where top investors and business leaders share their insights and provide an independent perspective. We hope you're enjoying this episode. If you'd like to learn more about Declaration Partners or listen to more episodes of the Declarations podcast, please visit our website at www.declarationpartners.com. And now back to the episode. It's interesting just hearing you explain it, and I know I've felt that in my own life. It is different from some of the headlines one might read, where the headlines might be, helping a rich person get richer. And while I guess as an investment professional, in some sense, that's the case, but in some ways, you're also suggesting that it's no different really than working on behalf of a nonprofit or an endowment, a foundation, even in some ways, maybe a pension fund. While the wealth is not as dispersed, much of the wealth is then going to a positive good, you're saying. Much of it becomes donated philanthropically or invested in companies that then have the advantage of changing the world. And so in that sense, the investment professional or the family office professional, you're saying, does his or her own share of good.
Well, that's the extension, right? Is that you are doing your own share of good. And while there are families out there that I'm sure aren't as I described, the families that I've worked with, almost without exception, fall into the category that I described. Maybe I've just been fortunate in not working with those families that are different.
I felt the same way. I mean, the philanthropy in the families I've worked with has been extraordinary. Now, let's talk a little bit about a book that you wrote. You authored a book. It's called The Family Office, right? So pretty obvious what your target is, but it's a little more detailed. It's The Family Office, a comprehensive guide for advisors, practitioners, and students. So who did you write that book for, and why did you write it?
I wrote it for myself many years prior when I got the job of running the family office. I was a tenured public accountant with lots of experience taking the job. And I got asked to do things I had no experience of doing, private aviation and residence management, and a whole host of other things. And all of our peers who are running family offices have the same experience, which is you get asked to do a bunch of stuff you don't know. So it occurred to me, there's a physician's desk reference, there's a venture capitalist desk reference. Why don't we create the family office desk reference so that the practitioners, not the principals, the people running the family office could go to the chapter on private aviation, for example, or residence management, and learn what it is and best practices and the like. And then I got connected to Columbia Business School, and they asked if I would add a pedagogical overlay so that it could be used by academics in teaching courses. And so we added a case study format where we come up with a hypothetical family that sells their company for $800 million. And then the book takes you through their life cycle, so to speak, and introduces the issues and the challenges and the approaches to solving them throughout. And it has been very well received, not just within the industry, but within the academic community as it's expanded to start focusing on family offices as well.
So I've read the book, and the fictional character, John Thorne, if I remember his name correctly, I remember John was a fascinating character because he's similar in some ways to the people you just described, right? He built something with his own wealth. He then faced some of these challenges of having a complicated life, but wanted to do good. He and his wife wanted to give to charity. They wanted to raise their kids, but they also wanted to enjoy and have time. And when you read the book, it sounds as if many parts of it are almost like how-to guides. You know, what are the things that family office professionals should look at such that they can figure out how to evaluate the different aspects? Is that really it? And is that...
It is a how-to guide. That's exactly the way to describe it. How do I do this, never having done it before? Where do I go to get guidance? And so if I have the family office desk reference, as I call it, on my desk, I can at least get a head start and figure out best approaches.
And so do people call you up and say, you know, thank you so much. You set me in the right direction. I was going to go the wrong way. Or the opposite. Do people say, gosh, Bill, I looked at this chapter and it sent me down a path that I should never have gone down and you were wrong? Do you get those sorts of phone calls?
I've been fortunate. It's always the former, not the latter. People are, I love, occasionally I'll reach out to somebody and they'll send me a text with a picture of the family office book that's on their desk, just to remind me that they read it. And I've been just so pleased at sort of the broad and positive reception because there's nothing controversial in that book. It's all about, you have a job to do. These are the various areas. These are the ways to do it. These are the issues you should consider. It's really viewed as very helpful, generally speaking. I haven't heard anybody give me been like, well, you got it wrong here, you got it wrong there.
Well, what are some of the takeaways from that book that you think are still a little bit underappreciated by the marketplace? What are some hidden gems that you would suggest are important?
The easy stuff is the technical stuff. How do I buy a plane? How do I get my residence in Cabo managed? How do I deal with payroll? And the hard stuff is interpersonal stuff. How do I manage the dynamics across the family, across the generations within that family office? The uniqueness of every family makes it a very impossible thing for somebody to learn other than by doing, by seeking counsel from others that are in that same situation, and by focusing on best practices and approaches.
One of the things that I found fascinating about the book, you've said this, and I can't remember if I read this in your book or if you've just said it at other times I've heard you speak, but you've said that great family offices generally succeed or are considered successful by their clients, not because of the pure excellence of their investment returns, but rather because of the trust and interpersonal communication between the family and their practitioners. So what are some of the hallmarks of that communication of those families that do get it right?
Well, there's different components to that. Now, one is the family itself. At the end of the day, they are the ones that need to evolve and develop, mature, address, and adopt the mechanisms of best practices. And there's the practitioners who are facilitators of all of that. And so the role of the practitioner is to facilitate it, to bring it up, to assist, to guide, to coach, to make it possible for the family to then, first and foremost, understand the importance of it. Secondly, to invest the time and occasionally the money to engage professionals to develop the governance protocols and the governance documents, and then to behave in a way that promotes cohesion, that addresses conflict in a constructive manner, that provides robust communication to the next gen and the gen beyond, to prioritize areas of focus, not just for themselves, but for others. Each family will be different, but there are best practices, and it's the application of those best practices that tends to make families look different. But when you peel back a layer, you'll find that they're generally starting from a foundation and they're building upon that in a very similar manner.
But to build that foundation, and importantly, to create this spirit of trust, you mentioned, good communication several times to facilitate good communication. It almost sounds that in addition to an analytical capability and, investments or tax or something, it sounds like you kind of need to be like a therapist, a psychologist, someone to really push for a better outcome. I mean, how does someone learn that they have that skill or learn how to apply it to a variety of different families in different situations?
Well, look, in the family office world, they talk about fit and function, right? You can hire people for the function, but they won't be successful unless they fit. And what they mean by that is, to your point, is whether or not they've got the right family office EQ. So,
and that can be different for different families, I presume?
It is different for different families, but it's not unique to family offices. Successful wealth advisors have to have great EQ. Markets go up and they go down. You have to be able to manage that. Great lawyers have to have good EQ. Doctors have to have good, as they call, bedside manner, right? So it's just a family office version of that skill set that's very particular to the family office. And it's not for everybody. I think a lot of folks struggle with that.
When you say a lot of
struggle,
folks,
one of the points,
do you mean the practitioners, or do you mean the clients?
The practitioners struggle with it, right? Because if you hire a senior person to run your family office, he or she is generally more expert at some issue, whether it's investment management or related, but they're also talking to a principal who is less expert, less experienced, but quite confident. And so,
usually deservedly so, right?
And deservedly so.
They've created their own wealth.
Some of the advice that I received from family offices as I was doing my research on the book, and I shared, is that there's this version of servant leadership. Normally they talk about CEOs have to apply servant leadership with respect to their employees. In this case, servant leadership is you need to provide leadership and you're serving the family office. And so you lead through education, not through fiat. I know what's right. We're going to do it this way. You have to educate them. You have to bring them up the learning curve. You have to address their concerns. And then the right answer tends to come out of those conversations. And if you're not comfortable doing that because you're not used to doing that, or you don't feel like you should have to do that, you're probably going to struggle in a family office environment.
That's interesting. So it really isn't, the next step after investment banking. It sounds like you actually need to have some other sort of skill set.
Yeah. And by the way, you've got to enjoy and appreciate the benefits of doing it. Because, that's where, going back to what I said, if you appreciate that the benefits of doing that are part of your job, that they're enormously valuable, then you'll spend more time on it because you'll appreciate just how important you are.
What are some of the characteristics that maybe a family should have or would have that would make them a better candidate for choosing a family office versus an MFO versus RIA or other wealth management solution?
Yeah, like so many things, the answer is it depends, right? It depends on a host of different variables. One is the magnitude of the wealth. One is the level of sophistication. Do they want to manage people? So a very wealthy, very sophisticated person might choose not to have a family office because they don't want to have to manage people, and they might decide to outsource it. And so every family, it evolves over time. The right answer and the right solution might change. People are people. And so if, they're controlling and they're very private, they're probably not going to change overnight to be delegatory and open. And so that informs what the solution is. So you have to watch the behavior, which then informs the right solution, irrespective of what the rhetoric was. And that's part of what makes the job challenging and why you have to be flexible and open-minded and patient in delivering the solutions.
You've mentioned people are people and implying that they are somewhat different from one another. But are there common themes? I mean, do first generation wealth creators frequently seek out advice and or structures or perhaps investments that are different from what their heirs or, second, third, fourth generation, inherited wealth clients tend to look for? And how does the advice that you give, either the practical, technical advice or the personality driven advice, I'd say the communication style, how does it differ between those groups?
There are definitely different groups. You've named some of the considerations or the categories, but they're not entirely so. A newly wealthy person may be different based on whether or not they built their business ground up. It's a closely held business versus a technology entrepreneur, for example, who really just wants to get back into starting the next company, for example. So you have to consider not just is it new money, but also where did the money come from? Because where the money came from tends to inform their personality and their areas of interest and their concerns. And you have to take that into consideration. I would say that, one of the things that advisors tend to focus on, and I think rightly so, is to identify those types of clients that they work best with. So, there's an old saying in wealth management that you look like your clients, or your clients look like you. And so generally advisors tend to fit better with certain types of clients because they're similarly wired, or they understand them better, or they've got unique experience with that client segment.
That's another great transition point. Let's use that you look like your client as maybe a jumping off point to talk about your new role. You recently joined Cynosure Wealth. You actually helped create Cynosure Wealth, which is a family office, or I guess it's a multifamily office / wealth management division at Cynosure. And Cynosure is itself effectively a family office organization. It founded originally by the Eccles family, which is a long-standing, very prominent, very philanthropic family in Utah. Let's delve a couple of layers into this over time, but maybe start with, why did you choose to do this, and how do you look like your clients in this role?
Yeah, well, I didn't choose it. It got chosen for me in some respects. I was at Silicon Valley Bank running one of the preeminent wealth management practices when the bank went bankrupt. And so we needed to make a change. I was fortunate in that I had a very long-standing relationship with the principals who co-founded Cynosure. They were clients in a prior life of mine, and I'd stayed in touch. And indeed, one of them contributed to the chapter on direct investing in the book. And they are, as a private equity firm, which is their bread and butter practice, investors in wealth management. So they knew my business. And so I called them up and asked if there was an opportunity for us. And they very quickly identified one and brought us over.
I want to point out, just before you continue, you suggested that there was not a choice. And yet what happened was that you decided to call them up and ask if there was a way to do it within Cynosure. That was voluntary. You could have very easily gone around the street with a resume and tried to find a different bank to join. You could have found a family office to join. So I'm going to push back a little. I think you did, in fact, choose to do this.
Yeah, forgive me. I answered not that choice, meaning if SVB had not gone bankrupt, I don't know I would be at Cynosure, right? And so, right, so I had to make a choice. And indeed, you're right, Todd. As you know, we had conversations with lots of different potential partners that were very interested in our practice. And we chose Cynosure for a reason, which I want to underscore. One was just their trust in us and our trust in them. And that makes a huge difference because we had to move quickly. The second was that the family's reputation, certainly in the Mountain West region, is extraordinary. The professionals there are very, very high caliber, ex-Carlyle, ex-Lucadia, senior, serious people who understand our business. And their need was clear. They wanted to complement Cynosure with a integrated wealth management practice to serve not just third parties, but also to serve the family members themselves, because that was still a gap in their coverage. They were great in managing the money for them, and the family office took care of the family office stuff. But the high-end integrated planning, they really struggled to be able to deliver it with the right team. Any of the people that I contacted are clients, and I said, we're thinking of making a change. Their response was, you should have done this 10 years ago.
You mentioned the reputation of the Eccles family, and you said, well, in the Mountain West, they are well known. I would argue that their reputation and their business success goes far beyond. Their legacy is truly amazing. I live in the Washington, D.C. area, as you know, where the Eccles building is actually where the Federal Reserve Bank is located, named after Mariner Eccles, who was the chairman of the Fed in the 1930s. So it goes back 100 years, their legacy. It's fascinating to know that this is a family office that has been successful for over 100 years, has been evolving since that time, is still regarded as very good at managing investments. And yet you said that they were missing something that you were able to provide. I mean, maybe if you could just spend a little bit of time talking about their legacy and what it was that you and your team have been starting to architect.
As it pertains to us, what they were missing wasn't the investment heft. It was the coordination, the integration. Going back to the prior question you had asked about what is it that wealthy families need that they're missing? And I talked about they have the best advisors, and yet they need somebody who's going to coordinate it and oversee it. They were missing that piece. And that's what we do, the quarterback. That's exactly right. And it's not just getting a quarterback, it's getting a quarterback who understands the issues and the challenges of families like theirs. Because quarterbacking in and of itself isn't enough. You have to have the ability to bring other experiences to bear. Because for many of these families, it's the first time they've dealt with it, but it's not the first time wealthy families have dealt with it. And so advisors who have worked with the other wealthy families they say that success leaves clues. It's working with enough other families that you view as successful, and then you look for the clues that help make them successful, and you share those with the other families you work with. And that's the secret sauce right there.
Got it. And now I imagine, therefore, in order to do that, you would advise not just the Eccles family and the variety of sort of their next generation, but you are also advising other people, probably some of your legacy clients, possibly new clients. What is it that you and your team are uniquely qualified to offer? If I were maybe a prospective client, why would I pick your Bill or Cynosure more broadly?
It sort of depends on where you're coming from, right? So if you just sold your company and you've come into an enormous amount of money and you realize that you need wealth management, planning, integration, reporting, and the like, we're probably as competitive as anybody else, partly because we've done it. And so they take confidence in the fact that they look like our other clients. Now, we're not unique in that regard. There are other very capable teams who do much of what we do at other firms. The challenge with the new person, the person who just came into money, is they don't know who those teams are. They may not be talking to them. There's a pyramid in this industry for a reason. First and foremost, there aren't that many clients as a percentage of the total number of wealthy people going on down to the mass affluent that have these needs. And so there's not that many wealth advisors who have spent their careers working with those families. And so the chance that that newly wealthy family is talking to the right potential other advisors is probably quite low. I would say for other families who have had their wealth for a while, we see this a lot. They're at name your top tier wirehouse. They work with name your big four public accounting firm. They're your international estate planning firm. And I won't belabor this point, but their life is still too complicated. And the top tier wirehouse, the estate planner, the CPA is not stepping into that governance, coordination, integration role. And so they need that. And that's what we do for a living. And they see that as valuable at this point in their life. And what comes with that is not just that role, but oftentimes they'll say, well, so-and-so wirehouse is managing their money. I know you guys manage your money. I have confidence that you'll do as good a job as they. So why don't you also do that? And so it expands the relationship.
And is there any difference or any influence, the fact that you are now managing the capital and perhaps more for these wealthy families, but you are yourself now part of an organization that is itself owned by a multi-generational wealthy family? Does that influence you in any ways?
Well, it helps me in the sense that I don't want to have to trade again. And
right. Okay.
This family is not planning on selling, nor do they need to. So it helps many of our clients, and they said this to us coming over from SVB, they were being forced to make a change, not because of something the private bank did, but because of something the commercial bank, right? And so a multi-generational, wealthy, sophisticated family that had no ambitions to sell or to, take private equity money, gave them confidence. And so right team, right family, and continuity, because you hear this all the time. If you ask them what it is that they value, one of the things they value is, if God forbid something were to happen to me, my husband, my wife, my kids are going to be taken care of. That weighs on them, and it's enormously important. And so integrated planning by someone like us or others who do it well is distinctly valuable to them for that reason.
Well, and presumably, so therefore is the comfort that comes with the stability of a family-owned organization that's been around for over a century. Let's spend a minute on investing. Wealthy families are often reputed to spend much more time and a larger percentage of their capital in the private markets, than some of you call the mass affluent. Do you find that it's easy to find good investments? Are you satisfied with the universe of investment offerings that you're uncovering these days?
In alternatives specifically?
Yeah, just in general, but I guess alternatives jump out at me because it seems that your clients are likely to do them in a higher proportion than some other clients.
No, look, it's no surprise that the sort of liquid capital markets, there's been a democratization about access over the last 10 or 20 years. And so you can find, if you want beta, as they say, pretty straightforward, and you can do it with an advisor, you can do it directly. So it's really where you start getting to where you want the kind of return potential that the alternatives can provide, that you start moving into that area. And there, the dispersion between the very best managers and the very worst managers is quite significant, as you know.
Selection becomes important, you're saying.
Selection becomes enormously important, and access becomes enormously important. And so I think one of the benefits for firms generally who are significant investors in alternatives is to really emphasize that they are spending the time and the resources to get that access, to do the selection, to try as best they can to pick those managers that are going to outperform relative to their peers. Whether we are good at that relative to others, I'm not going to comment. The family itself has been very successful, and the firm is populated by extremely senior, successful folks in prior lives and while at Cynosure, and we have an enormous amount of confidence in their ability to be successful. And I think that is one of the reasons that families at least consider us for that.
Now, let's maybe in the wealth management industry more broadly, although perhaps this relates to your clients specifically as well, we're about to experience an extraordinary generational transfer of wealth, and I guess of control over that wealth as well to the next generation. So how do you counsel families around those issues? What are some trends you're seeing, and how does it influence their investment decisions?
Yeah. Well, first, the one shift that I've seen over the 30 plus years that I've been doing this is that in a much, much greater number of families aren't giving all their money to their kids.
Where are they giving the money? To charity then?
Yeah. They've set aside through planning what it is that they want their children to get. And then their only other choices are to give it to the government or to give it to charity. And I've yet to have a client say he wants to give it to the government. So by default, it's going to charity. And in those situations, our contribution is to point out, well, that's a big amount that you're going to be given to charity. Do you want to give some thought now to what that looks like, what it focuses on? Do you want to involve your children, or what's the right mechanism by which that very significant philanthropic portfolio is going to be managed? Because it's not easy.
Well, let's talk, actually, in some ways, whether one would call it philanthropy or just time well spent, you have spent a lot of your own personal time in trying to build similar community, right? Similarly educating people around that. And now I'll acknowledge that it's specifically focused on the area of your expertise, which is to say family offices. So you've written the book, but now what you've been doing is you've also been critically involved in building family office initiatives at each of Stanford and at University of Chicago. Why are you so passionate about education for family office practitioners? What's missing that you're trying to fill the void here?
The one at Stanford had been around for a while, and it was an endeavor to bring family offices to the early stage tech and related innovation. That Stanford, going back to my point about family offices make a difference, is that they will make investments in technology before it has commercial application in a way that in corporate R&D and venture, even its size, is less likely to do so. And that's enormously helpful. The one at Booth, though, is a more recent one. And its ambition, to your question, is to really help not just professionalize the family office industry, so to speak, but to generate the research through an academic discipline, have programs to promote not family offices, but rather promote best practices by sharing those and identifying that. I think it's well on its way to becoming one of the preeminent family office dedicated initiatives, hopefully growing into an institute at some point. And the reason I care so greatly and I spend so much time is for the reason that we started out. I want to contribute. This is a way I can leverage my experience and my background and my interest, right, to pursue a purpose of professionalizing family offices, which then help wealthy families, which then I believe helps society. So it has a broader application and a very, very, very big dividend down the road.
Well, that makes sense. One of the other things that you do to give your life purpose, I presume, and has dividends that are paid down the road, is your time that you spend with a nonprofit that's called First Graduate, which I believe, as the name implies, helps students become the first of their families to ultimately graduate college. So why is that one important to you? I presume similar reasons?
Yeah, and it was started 20 years ago. I had a client of mine who said she wanted to assist a LA-based charity that helped children become the first in their families. And we got some great advice from the principal, Dr. Gary Gitnick, now deceased, who was extremely well-respected and extremely successful in their program. And his advice to us was, I'll assist you, I'll be on your board, but you need to do it in San Francisco, where it was at the time, and make it local. And he was absolutely right. And so I helped raise some money. I was the president of it for the first 5 years until I left and moved from San Francisco to Chicago. And I am delighted to see 20 years later, that First Graduate now has so many alumni who have gone through the program, who give back, and who themselves have broken through this glass ceiling in a family. When you become the first in your family to go to college, your siblings after you go to college. All of your children go to college. And so it has a leveraging effect, like a few other things. And then finally, we used to do fundraisers. We would invite folks who proudly were the first in their families to go to college. And you wouldn't believe the people, a little old charity who reached out and said, would you like to come talk about your story? That we were able to get to come talk about their story because they lived it, they believed in it, they wanted others to hear their story. It's been an enormously rewarding experience for me, a creation experience, even though I've stepped away from it. And it's a good example of, if you care about it, give it a try. If I had known what it took, I probably wouldn't have done it. And the good news is I didn't know how difficult it was going to be. And yet I threw myself into it with an enthusiasm that ended up paying enormous dividends, not just to me, but to the broader population of kids.
It does seem that those things that are most rewarding in life take a little bit of effort, perhaps more than you expected. The real wonderful thing, Bill, will be when one of these first graduates becomes the first in their families to also have a family office. I'm sure they'll come running to you as a potential advisor. It has come the time in our discussion for what I call our closing questions. Bill, if you could give us a book that most influenced your thinking or your personal development.
It's going to date me, but somebody once wrote a book about someone moved my cheese.
Who moved my cheese? Yeah. It's a great book.
It teaches you, right, that sometimes things are going to change. I just lived through somebody moving my cheese when SVB went bankrupt, right? And you persevere and you work through it. And generally speaking, you end up with a better outcome oftentimes than you ultimately would have been had those challenging things not occurred. So,
what is the best advice that you received from your parents or that you now give to your own children?
Simplify. When things are going on and you're struggling, simplify. Complexity has a cost to it. It's true in personal affairs. It's true in wealthy families. And so it's not to have multiple things going on, but to simplify so you can focus.
That's a good one. I could use that. The Declaration of Independence talks about life, liberty, and the pursuit of happiness. What do you do in pursuit of happiness?
Well, I'm one of those people who enjoys my job. And so when I'm busy, when I've got more to do and I'm trying to seek that simplicity, I'm actually enjoying myself, believe it or not. I'm also one of those people, having grown up around very wealthy families my whole life, realize the happiest families I've ever met were ones who never had to work another day in their life. And yet they stayed employed in the things that they loved doing. And then finally, having also grown up with wealthy families, I saw that their contribution were the children and the quality of the family that they developed, because money can make that very difficult. And so I've spent an enormous amount of time with my 4 children, developing them, trying to leave them in a better place with the right starting point, the right foundation, the right orientation to be successful in their life so that they can lead a successful, purposeful life as they possibly can. And then when I have extra time, I'll go ride horses. So I'm an equestrian. My daughter was a very accomplished equestrian.
Down in Wellington, correct?
Exactly. And that's my way of getting out. And, there's a very famous about quality of life is when you ride a great horse and you connect. And horses have been proven, to be very therapeutic, not just for folks with disabilities, but just generally folks who, need to connect to and learn what it takes to influence such a powerful, beautiful animal. And it's not brute force. I actually found a way to put a quote into my book, an equestrian quote, which says, you can never force a horse to do anything. You can only suggest it. The same is true with your principles. You can't force your principles to do anything. You can only suggest it, which gets to my earlier point about executive fiat being something to be very cautious about exercise.
I think that's a great way to end. You can't force people to do anything. You can only suggest it. Wonderful advice from one of the world's most renowned practitioners in the family office space. Bill, this has been a real pleasure. Thank you so much for taking the time.
My pleasure, Todd. Take care.
This podcast is provided for discussion and informational purposes only, for use by Declaration Partners, LP, together with its affiliates, referred to as Declaration. The information discussed in this podcast may change at any time without notice, and there is no duty by Declaration to update any person to whom this information is provided. This podcast does not constitute an offer to sell or the solicitation of an offer to purchase any investment product or any interest in the fund or any other investment vehicles or accounts managed or advised by Declaration, a Declaration investment product, in any jurisdiction to any person. Any such offer or solicitation for interest in any Declaration investment product will only be made pursuant to such Declaration investment product's definitive offering documents, which contain a description of the material terms, including risk factors, conflicts of interest, fees and charges, and regulatory and tax considerations relating to such Declaration investment product, and which should be reviewed carefully by potential investors prior to making an investment decision. This podcast does not constitute tax or legal advice. The listener is urged to consult a professional tax and/or legal advisors regarding the possible tax, legal, economic, regulatory, or other risks and consequences associated with any investment, and must be able to bear the risks involved. This podcast may contain certain forward-looking statements which constitute Declaration's views with respect to future events, which can be identified by the use of forward-looking terminology such as intend, seek, expect, target, project, or endeavor. These statements are made based upon such views as they exist as of the date herein. There is no assurance that such views are correct or will prove, with the passage of time, to be correct. Actual events or results may differ materially from those contemplated by such forward-looking statements as a result of factors beyond Declaration's control, including, without limitation, any disruptions in global, regional, or local financial, credit, or real estate markets, acts of God, fire, hurricanes, tropical storms, floods, earthquakes, or other natural disasters, outbreaks of an infectious disease, pandemic, or any other serious public health concern, war, terrorism, labor strikes, electricity shortages, or other national or local emergencies, or any combination of the foregoing. David M. Rubenstein is an anchor investor in Declaration Partners Real Estate Fund II and is not an employee of Declaration. Neither the U.S. Securities and Exchange Commission nor the Securities Regulatory Authority of any state or other jurisdiction has passed upon the accuracy or adequacy of this podcast. No compensation has been awarded to any speaker for statements made that are either testimonials or endorsements. However, certain speakers may be current or former investors in certain Declaration investment products and may receive reduced fees, priority terms, priority access, co-investment rates, among other preferential treatment, which may pose a conflict of interest. Certain speakers may also be affiliates and/or service providers that receive compensation from Declaration for services provided in their service provider capacity, but have not been compensated specifically for any testimonials or endorsements made herein. All statements made on the podcast are the opinions and beliefs of the speaker and may not necessarily represent the opinions, beliefs, and position of Declaration. Consequently, from the foregoing, no reliance whatsoever should be placed on this podcast, and no decision including any investment decision should be made based on this podcast or on the information contained herein. The views expressed in this podcast by the guest speaker are their own and may not reflect the views of their firm or its affiliates. The comments made are for informational and educational purposes only and should not be considered investment, legal, or tax advice, nor a recommendation or offer to buy or sell any security or investment product. Any references to advisory services, private investments, or wealth management practices are general in nature and not indicative of future results. Past performance is not indicative of future outcomes. Examples and observations shared by the guest speaker are illustrative only and may not reflect actual client experiences. Listeners should consult their own professional advisors regarding their individual circumstances. The guest speaker may have professional relationships that could present potential conflicts of interest. The guest speaker has not been compensated for any statements that could be viewed as testimonials or endorsements.